Welcome and thank you for joining us today. My name is Sean Moss with Down Payment Resource. We also have with us Fern White, who oversees our customer success, and Melinda Harris, who is our marketing director. They are in the background. They are going to be answering questions and reacting to comments as we go. So we want to keep this interactive. So please use the Zoom questions panel. You can use the chat if you want. If you have any questions, if you have any insights, if you have any stories you want to share about working with down payment assistance programs or buyers that used them, then please do keep this interactive. We'll leave time at the end for questions, and they'll be answering in the background as we go. So with that, my name is Sean Moss with Down Payment Resource, and today we want to talk about the basics of homebuyer assistance programs. So this is essentially your DPA 101 course. We're going to talk about what agents need to know about down payment assistance programs in order to confidently bring them up and discuss them with clients, with prospective buyers, with incoming leads, and so forth. We're not going to make anybody an expert today. That's not the goal. The goal is to give you enough insight and information and context to bring up down payment assistance and to do so with confidence and to be excited about it. So ultimately, our goal is to help connect home buyers to the down payment help they need. In order to do that, obviously, we all need to educate ourselves about down payment assistance so we can put those solutions on the table for prospective buyers, for renters that are considering home ownership, first-time home buyers, and so forth. We are at Down Payment Resource, a national database and a matching engine of the roughly 2,200 home ownership programs available across the country. We're going to talk about what they look like. We're going to talk about who they come from, some unique characteristics, some commonalities across these programs, but also know that our technology has been integrated into some of your MLSs. We'll look at who our MLS partners are. So we do flag eligible listings as eligible for down payment assistance. And we also provide other tools and data and information to help you, agents and loan officers. We do have some loan officers with us today, to be the down payment hero to your buyers or to your borrowers. Now, when we say home ownership programs or home buyer programs, broadly, we are talking about loans, grants, tax credits, and other programs that are out there for eligible home buyers to achieve their down payment faster, to help cover closing costs, and ultimately, we hope to get them into a home sooner than they would have otherwise. Often that means recognizing the opportunity to create a buyer and to create a transaction while recognizing down payment assistance as a solution for the biggest obstacle to home ownership, which, as we all generally know and agree, is the down payment. Now, just a quick overview of the different types of home ownership programs that are out there. We track, as we saw a moment ago, about 2,200 such home ownership programs. 78% of those are down payment or closing cost assistance. Those are programs that provide at closing help to reduce the LTV, to increase the down payment, to cover closing costs. We also track mortgage credit certificates. We're going to dive into those today. Those are tax credits. They're available in many states and many markets. We also track and monitor all of the affordable first mortgage products that mostly come from state and local housing finance agencies, but themselves offer unique benefits and opportunities for buyers. And there are some other types of programs out there, matched savings programs, housing choice vouchers, and others that make up about 11% of all these homebuyer programs. What we're going to do today is dig into the three most common types of homebuyer assistance. As we do, we want to make sure that as we say things like DPA or down payment assistance, that's a pretty broad category of programs. They're not all the same. They don't have the same repayment terms. They don't have the same qualifying guidelines and so forth. So to break that down for just a moment, when we talk about DPA or DAPS or down payment assistance, that's a broad category. Some of those are grants. They are gifts at closing. The ones that are not grants, they can come in several forms. Some of them require monthly repayment. Some of them, in fact, 2/3 of them, defer payments, meaning there is no monthly payment for some period of time or perhaps for the duration of ownership of that house. Some of those down payment assistance programs are forgivable. So while they may not be a grant up front, 45% of down payment programs across the country are forgivable in part or in full, sometimes incrementally over time. Sometimes they're forgiven at a certain period in the future. 40% of all of these down payment assistance programs are both deferred and forgivable. So the reason I point that out now is that as we dive in here, I want to make sure everybody has some context. First of all, to understand that there are a number of different types of homeownership programs, the most common being down payment assistance. But even within that category, there are many different flavors, many different styles of down payment assistance, some being grants, some repaid, some with deferred payments where you don't have to make a monthly payment and pay it back down the road. Some are forgivable. So they essentially become a grant at some point in the future. Now, with that context, let's talk about where these programs are, where they come from, and so forth, and then we'll break down the most common types. So there really isn't a market in the US that isn't covered by some form of homebuyer program. And that is largely because every state has a state housing finance agency or sometimes multiples. So their programs cover the entire state. Now, many markets have cities and counties that get funding from HUD or from Community Development Block Grant or other sources to fund local homebuyer programs. Nonprofits fund down payment assistance and homeownership programs. And we'll look at some more of the providers. Who do these programs come from in a moment? But these programs are literally everywhere. The state housing finance agencies cover the entire states, and then there are local opportunities that are layered in and littered throughout the country. Now, in bigger states, you see more programs. California, Florida, Texas, obviously they're bigger states, more people, more real estate. And so there are more programs there, more cities and counties and so forth. But quite frankly, there really isn't a market in the country that doesn't offer some sort of down payment assistance to some sort of audience. And we're going to look into that more. But first, let's talk about where these programs come from. Who offers homeownership programs? Who offers down payment assistance? I already mentioned every state has a state housing finance agency, at least one. There are local housing finance agencies as well in many markets throughout the country. Additionally, we see programs from cities and counties. We see homebuyer programs from employers that they use to retain or to recruit talent, offering homeownership incentives in order to do so. There are nonprofits all over the country that are engaging in all manner of community development and housing initiatives, including funding down payment assistance or closing cost programs. In addition, we see housing authorities, community development financial institutions or CDFIs, Federal Home Loan Bank System. They provide funding for down payment assistance programs all over the country through their network of participating banks and other organizations, land trusts. And while that's not necessarily tip of the iceberg, those are examples of many of the most prominent organizations or types of organizations from which we see down payment assistance programs. So they're all over the country, coming from all manner of organizations. And now let's talk about trends. Now, we heard a lot last year and even coming into this year about down payment assistance is gone. Down payment assistance programs are going away. They're all out of money. They closed their doors. So we want to just be crystal clear. That is completely false. All state housing finance agencies are now and have been open without disruption through last year, through COVID, into this year. They have remained open, accepting reservations, working with their real estate and lender partners, and issuing their down payment assistance programs to consumers. Additionally, local program providers, cities, counties, nonprofits, and the like still are widely available. We are, in fact, weekly, we're still seeing new programs hit the market from state housing finance agencies, local housing finance agencies, municipalities, nonprofits. Part of how these programs remained open through COVID and now and going forward is that they began offering more and more online homebuyer education. As many of you know, most of these programs require a homebuyer education course be completed by the buyer. However, many of them did so through in-person classes. When COVID hit, many of them migrated to online options that had already been there for years, but that enabled them to provide their programs and to continue to provide their programs to consumers and support you, the professional audience. I'll also add, last year, many state housing finance agencies experienced record volume, in part due to record low interest rates. But we also have to recognize that that's in part because of increasing demand for down payment assistance programs and increasing awareness or recognition of the value and the opportunity that they provide. So that is all, and especially for you loan officers listening in, that's all purchase business. That was not refinance business. Housing finance agencies doing record volume to the tune of tens of billions of dollars. That is purchase business with down payment assistance. And if we think about now, we've got concerns about inventory, obviously, about bidding wars and so forth, and buyers that are getting FHA financing or using down payment assistance being squeezed out of that process. We have an entire webinar being built to address those topics and to provide solutions and best practices. But suffice it to say, last year and even going into this year and already this year, we are seeing record volumes from housing finance agencies with purchase business using down payment assistance programs. And lastly, just to cover these trends and drive home the point that down payment assistance programs are not going away, nor did they. Over 80% of all of those programs across the country are today currently funded and available. Now, that doesn't mean that 20% of them ran out of money. That's actually a normal number because these programs are not all funded all year long, all at the same time. That's true of state housing finance agencies. They're perpetually funded. But some cities and counties, their funds come and go. Federal Home Loan Bank funds come and go. There's some seasonality to some of this. So we're in a normal position. We did not see a notable reduction in the availability of down payment assistance. We saw increased demand. A normal number of them are funded, and this has been the case over the last year and a half. So down payment assistance programs are here to stay. I'll leave it at that, but we wanted to combat any notion that DPAs are gone with some statistics here for you. Now, let's get into some sort of universal requirements of homebuyer programs. We've talked about tax credits, down payment programs, closing cost programs, some affordable first mortgage options. Before we break down some of those most common program types, let's just look at universal requirements. Who's the audience, for example? These programs are only for owner-occupant buyers. They are for buying your primary residence. These programs are not available for purchasing second homes, vacation homes, rental properties, and so forth. They're also for residential properties. So this isn't for commercial. This isn't for farms and raw land. These programs are to help buyers purchase the home that they're going to live in. They also all require some minimum buyer investment. That can be $500, 1% of the purchase price. Part of that investment on behalf of the buyer is attending and completing a homebuyer education course, which we at Down Payment Resource are big fans of because that, and we'll talk more about homebuyer education, but that prepares them not just for the transaction, but for the obligations of ownership down the road. And then, of course, we're not talking about cash buyers, right? We're talking about buyers that have to go get a first mortgage and then are going to use the down payment assistance program with that. So, of course, they have to qualify for a mortgage. And then we look at down payment assistance options along with that mortgage. Now, to combat a myth here, we all hear it, and it's sad, quite frankly, that this myth or misperception still persists so rampantly among potential home buyers, especially the younger they are. The idea that they need 20% down to buy a home, or that without 20% down, home ownership is not possible. So a lot of what we're going to talk about today is to combat that specific misperception on the part of an overwhelming number of our potential future clients, and make sure they understand that not only can you get a home with 3% down, 3.5% down, 5% down, but maybe even zero if you're buying a qualified rural property and you can get a USDA mortgage, if you're an eligible veteran and you can get a VA loan, those are opportunities to get a home with zero down. And so as we go through, keep that in mind. How are we going to combat that misperception among likely millions, if not tens of millions, of mortgage ready buyers who may not take it seriously because they still somehow think they need 20% down? Now, before we break down payment assistance programs versus affordable first mortgage programs versus mortgage credit certificates, which are tax credits, I want to ask Melinda in the background to put up a poll on the screen here, and you'll be able to answer on the screen, but tell us how much of your business comes from first-time home buyers. And you can click your answer on the screen and just tell us, what portion of your business, what portion of your volume is made up of first-time home buyers. Is it minimal? Is that your primary source of business? Somewhere in between? Let's just gauge the audience real quick, and then we'll continue going. So go ahead and enter your answer on the screen. We've got a big crowd. We'll give you a couple seconds here to do so, and then we'll share the results. All right, and Mel, if we get to critical mass here, let's share the results. Okay, so that's a relatively even spread. So let's see, about a third of you, roughly half, somewhere near half your business comes from first-time home buyers. About a fifth of you, the majority of your business comes from first-time home buyers. In fact, that's a whole nother third. So for about a third of you, a majority of your business comes from first-time home buyers. And for some of you, a very small portion of your business comes from first-time home buyers. That may be because your focus is luxury, your focus is commercial, your focus is relo. I don't know, it's your business, right? But what we want to do today is, no matter where you fall on this spectrum, and we can take that off, no matter where you fall on that spectrum of first-time home buyer business, we want to make sure that as those opportunities arise, or as you continue to develop that channel for yourself and the relationships that drive that business, we want to make sure that you've got a working knowledge of the basics and even some of the nuances and specific opportunities that down payment assistance programs or home buyer programs broadly can provide. And make sure that we recognize those opportunities when we're faced with them and can create transactions and buyers and opportunities for ourselves, our partners, and these consumers by way of these home buyer programs. So we're going to cover the basics. We're going to break down the three most common types of home buyer programs now. And we're going to start with the down payment assistance program. So we mentioned earlier, 78% of all the home buyer programs across the country are that at closing down payment assistance or closing cost help. So let's then look at that first, because that's the most common type of help out there. Now, down payment programs is a broad category. Down payment assistance, DPA, we've already covered that. And to an extent, we covered the differences among DPA programs when we talked about repayable versus deferred versus forgivable, and some even are grants. But knowing this is the most common type of home buyer program and that they vary widely across markets, across programs, no two DPAs are the same, then let's kind of dig into some other nuances here. These are by and large nonprofit or government funded, except maybe in the case that they come from employers. These programs can offer several thousand to tens of thousands of dollars. And I'll add there that the assistance amounts all often reflect the price of housing in that market. So you'll see more assistance in a program in San Francisco than you would in Cleveland, for example. But that's reflective or representative of the fact that housing is also more expensive there too. We're going to come back to that idea when we talk about income and purchase price limits. But I won't go into too much more detail here, but I do want to clarify again, when we say DPA or down payment assistance, that's a very broad category. They're all different. Some are grants. That is a true gift forgiven at closing, does not create a lien, does not create a second mortgage. Some of those are repayable. You get the down payment assistance with your mortgage. Maybe it comes with zero interest, or maybe there's an interest rate. Some of them do have a monthly repayment. Sometimes that starts immediately along with your first mortgage. However, some programs will defer payments on the down payment assistance often until you sell or refinance or move out of that property. And then down the road, that assistance becomes due and you pay it off when you sell the home, for example. Yet some programs, and we looked at the numbers earlier, some programs are also forgivable. Now, that can come in many forms. They might be forgivable at 20% per year over the first 5 years, ultimately being completely forgiven after the fifth year. Or you may have to live in the home for 10 years. And after you've done so at that 10th year, the entire down payment assistance is forgiven. There are many forms within each of these categories, right? There are many repayment options and terms within these categories. But again, the larger point here is down payment assistance programs is a very broad label. There are many types of programs and many nuances to them within that category. Now, what can these programs be used for? Obviously, the down payment, often closing costs. Sometimes they can be used to cover prepaid expenses, so covering escrows and so forth. Many programs will allow the funds to be used for property repairs or rehabilitation. So bringing it market ready, bringing it up to code, that kind of thing. Those are less common, but there are some out there. Sometimes if there's money left over at the closing table, then that gets dumped back into a principal reduction, which is really just more down payment anyways. So those are the most common uses of DPAs or down payment assistance programs. Many of them do have a first-time homebuyer requirement. However, I want to take a moment here to combat yet another myth or misperception that down payment assistance programs are only for first-time homebuyers. That is not true. In fact, 41% of the programs around the country do not have a first-time homebuyer requirement, meaning the door is open for repeat buyers, previous owners, even sometimes current owners. Now, part of addressing this myth is also understanding the definition of a first-time homebuyer, at least for the purposes of down payment assistance. Most of these programs, in fact, generally speaking, universally, they all follow, HUD or Fannie or Freddie. They have all got different language about this, but essentially, they all follow the 3-year rule. You are a first-time homebuyer if you have not owned a home in the last 3 years. Now, the language might differ. If you haven't had ownership interest in a primary residence in the last 3 years, there are exceptions for divorce, displaced homemakers, and so forth. There are often exceptions for veterans. We're going to look at some of those exceptions later. But it's important to remember that if you haven't owned a home in the last 3 years, you're a first-time homebuyer. So if you bought a home 7 years ago, sold it 4 years ago, you're a first-time homebuyer. For the purpose of down payment assistance, you're defined as a first-time homebuyer. So want to make sure we made that clear. These programs are not just for first-time homebuyers, which makes us think or must make us think, how large or how much broader an audience could I serve with these programs if I recognize these opportunities when they come up, and if I understand a little bit about the programs in my market and their first-time homebuyer requirements or lack thereof. Now, what are some common terms that you might hear? Grant, that's a true gift, forgiven at closing, no lien, no loan, no repayment. Forgivable, we've talked about that. We talked about deferred payments. An affordability period, that is the time or the period of time over which a buyer using a down payment assistance program must remain in that home as their owner-occupied residence in order to accrue those deferral benefits or those forgivability benefits. Sometimes you'll hear down payment assistance loans, if it's not a grant, called a second lien, a subordinate loan, a silent second, a soft second. Those are all, they're not synonymous terms, but they're all different ways of describing different down payment assistance loan scenarios. There are some programs out there that have a shared equity component. It's not that common, although we may see more of that in the future. But essentially, that's an exchange of down payment help up front for a portion in the increase in equity. So the equity growth from the time of purchase to the time of sale. So not all the equity, just the growth in equity from the time of purchase. That's not too common. We're not going to dive too much into that today, but if you hear it, that's basically what it means. Now, what are the eligibility requirements for a down payment assistance program? Most programs have income limits. Most programs have sales price or purchase price limits. Now, a couple things about that. There are some programs that don't have limits, but they'll have other criteria. Income and purchase price limits are always market adjusted as well. In fact, they are often based on HUD or Fannie or Freddie's calculations for area median income. So they are based on the average income in that market. Most programs, or many, let's not say most, many programs will cap out at 80% of the area median or average income, but many programs will go way over the average. So if that's the average income in that market, in that metro area, many programs will go up to 120%, 140%, sometimes as high as 200% of the area median income. So when I mentioned earlier that assistance amounts can vary from several to tens of thousands of dollars because they're market adjusted and often reflect the cost of housing in that market, income and purchase price limits are also market adjusted already by being based on those area median income limits, but they also can go up to well beyond the average incomes in that market. So again, I want to reiterate that expands the eligible audience, the potential audience, that expands the pool of prospective buyers we may be able to serve with these programs if we recognize those opportunities and understand the requirements of these programs and bring them up when appropriate. Now, some other eligibility requirements: property location. Where does that buyer want to buy a home? That makes a big difference because as we mentioned earlier, the state housing finance agency, their programs are available statewide, right? But as you move from one city to another, or one county to another, or one neighborhood to another, the local cities and counties and nonprofits and others that also offer down payment assistance, they're going to have smaller geographic boundaries. Their service area will be within their own city limits. A nonprofit may be regional and serve a multi-county area in a specific market. So location makes a difference because that adjusts the opportunities that are out there for a buyer based on where they want to buy a home. Now, FICO and more generally credit criteria, we mentioned earlier, we're not talking about cash buyers. We're talking about buyers that are getting a mortgage. They have to qualify for a mortgage. There are FICO and credit criteria for that, but also a lot of these down payment assistance programs will have a minimum FICO and certain credit criteria that must be met to qualify for their program that by and large reflect first mortgage guidelines typically anyways. For example, most down payment assistance programs will want a minimum FICO score of 620, 640, somewhere in that range or higher. Homeownership history, that's really back to the first time homebuyer requirement, but we'll reiterate by saying not every program has a first time homebuyer requirement, but homeownership history can make a difference in qualifying for one DPA versus another, or determining which programs are available to a buyer based on their homeownership history. Military service and profession. I'm going to point those out now, but we're going to take a deeper dive into that in a few minutes. Anybody with a military background, actively serving or a veteran, guard, reserves, there may be additional opportunities out there for them. Likewise, there may be hero programs or others that are available to people in certain professions. We're going to talk about those more, so I'll move on from that for now. But let's talk about the advantages of down payment assistance. So obviously, it's a bigger down payment, right? But when we think about it, and we think about it in the terms of making offers, of getting more people pre-qualified, getting them pre-qualified faster or with better terms, building our purchase pipeline, educating our prospect base, I wanted to point out some advantages that maybe are not as commonly espoused or as commonly recognized. So loan to value. Obviously, with a bigger down payment, you are reducing your loan to value. But think about what that can mean. Let's say a borrower qualifies for an FHA loan, 3.5% down, upfront mortgage insurance, and monthly mortgage insurance for the life of the loan. Well, what if a down payment assistance program could get them to 5% down with that down payment help, and then they can get rid of that upfront mortgage insurance, they can reduce the monthly mortgage insurance premium, and they can drop that mortgage insurance off once they get to 80% LTV or 78% LTV. That's a big difference, right? And that's just by applying a down payment assistance program. So yes, it lowered the LTV because yes, the down payment was bigger, but now it impacted first mortgage options, mortgage insurance pricing, maybe interest rate as well improved, lowering debt to income, DTI, or qualifying ratios. So we work with lenders a lot, and we've done what we call a declined loan analysis and looked at thousands of declined loans and determined that about a third of them were eligible for down payment assistance. Not just those loans that were declined for cash to close issues, but also loans that were declined for qualifying ratios. If someone is borderline on qualifying ratios and maybe the automated underwriting systems aren't giving you an approve or an accept, what about applying a down payment assistance program, lowering the LTV, potentially improving interest rate, mortgage insurance pricing, lowering the monthly payment, thus lowering their qualifying ratios? That's another potential advantage that, again, might be all too often overlooked, that can create more buyers and salvage more prospects that are already into the pre-qualification process, but maybe didn't make it out the other end because a down payment assistance program wasn't considered. And with that, they could have become a buyer and lowered their ratios. Now, all of this, of course, is essentially speaking to lowering monthly payments, better, the best available first mortgage product, better rates, better mortgage insurance pricing, lowering ratios. All of that is a byproduct of lowering monthly payments, right? Or that sort of works both ways. But supplementing cash to close and helping a borrower retain their savings. So I mentioned, think about this in terms of bidding wars, making offers, trying to win a contract on a home. On one end, if we can help a buyer save more money and retain savings, retain liquid money, they're better off going into the home. And in fact, we've seen studies that suggest that just 2 or 3 months worth of mortgage payment in savings when they move in the home has an enormous impact on reducing default rates down the line. And that's what we want, right? We don't want default rates. We don't want foreclosures. We want people to stay in the homes too. But supplementing cash to close, if a DPA program allows the funds to be used for closing costs, then what if your buyer doesn't ask the seller for closing costs, gives them a competitive offer, and the seller looks at that and says, okay, that's a competitive offer, and I don't have to pay your closing costs. I, as the seller, net more from the proceeds of that transaction. And if framed appropriately, if you're framing that offer, pitching the value or highlighting the value of that DPA program by saying, hey, look, you're not going to have to pay for their closing costs. You're going to make more as the seller from this offer. That's another way of recognizing value and advantage in a DPA program. Now, all of this basically speaks to increased purchasing power for your buyers, helping them get qualified, helping them afford the home they need, keep savings in their savings account. All of this helps increase the purchasing power without changing their income, right? Income remains the same, but they're able to purchase more, or they're able to purchase at all because of a down payment assistance program. All right, now, lastly, homebuyer education. Most of these programs require that the buyer, using their DPA, complete a homebuyer education program consisting of HUD certified content, bring the certificate of completion to the loan officer, prove that they went through the class. We mentioned earlier that increasingly there are online options available. They've been around for years, but we're seeing more and more usage of online homebuyer education options, which in part means the buyer doesn't have to necessarily wait around for a Saturday class. They can start and finish that homebuyer education course at their leisure, but also at their pace. So if they want to expedite that process, if they want to do it sooner, they can do it sooner. And by the way, there's no reason to wait on homebuyer education courses. If you've got buyers coming in and you think they're going to use a down payment assistance program, or if you just think they would benefit from the experience, then promote the idea of doing that homebuyer education class early on. most education courses or most DPA programs will accept that course completion for a year. So they have a year to buy after they do that course. There's no reason that has to happen in the middle of a transaction. But I'll leave you with this when it comes to home buyer education. We are big proponents at Down Payment Resource, and there has been research from a number of reputable organizations that shows that homebuyer education not only prepares buyers for the home buying transaction, but it is also preparing them for the obligations, the budgeting, the expectations of long-term successful home ownership, how to stay in the home. So for that reason, we are particularly in favor of homebuyer education. Now, that was all DPAs. Right? A lot of that carries over to first mortgage programs, but let's talk about affordable first mortgages, another one of the three most common types of homebuyer programs. What are we talking about? We're talking about mortgage options, typically from state or local housing finance agencies, where you get the mortgage through there and also their down payment assistance. So that's one of the benefits, is that you're combining these affordable mortgage options with down payment assistance and sometimes even tax credits. But sometimes they come with reduced interest rates. Sometimes this can generally expand first mortgage options. Housing finance agencies, by the way, have access to mortgage products that may not be available elsewhere. HFA Preferred, HFA Advantage. These are mortgage products that offer mortgage insurance benefits, reduced mortgage insurance costs. They may have other benefits as well. So that expands the pool of first mortgage options that could be available to a prospective buyer or borrower, and they can be used in conjunction with DPAs and tax credits. Now, what are some of the advantages of affordable first mortgage products? Reducing the buying costs. And again, this goes back to the DPA benefits. A lot of these are the same, right? A DPA can impact the nature of a first mortgage, but a better first mortgage product or more options can also help lower payments, reduce MI costs, increase purchasing power. And all of this combines to help expedite home ownership for people that may not have been ready or realized that it was possible or realized that they were mortgage ready. Now, lastly, I want to cover mortgage credit certificates. These are tax credits. They're not available in every state or every market, but where they are available, these are wonderful life of loan opportunities to gain value. So let me explain. A mortgage credit certificate is not down payment assistance. It's not a mortgage. It is a federal income tax credit. Now, that's different from an income tax deduction. We're all familiar with the mortgage interest deduction. You know, the mortgage interest you pay, you deduct it from your taxable income. That lowers your tax bill a little bit, right? Or maybe a lot. Depends on your interest. A tax credit is a dollar for dollar reduction of the tax bill. Now, in the case of a mortgage credit certificate, these have to be issued prior to closing. You can't retroactively go back and get a mortgage credit certificate from one of these providers. Presuming you get that mortgage credit certificate where available prior to closing, you get to use that certificate every year for the life of that mortgage. So every year when you file your federal income tax return, you get to claim some portion of your mortgage interest paid as a tax credit, a dollar for dollar reduction of your tax bill. That's annual, that's life of loan. It helps offset the mortgage interest cost of home ownership. And additionally, you still get to use the mortgage interest deduction for the rest of the interest. So I realize we may be getting into the weeds here on tax stuff, but basically one of the benefits of a mortgage credit certificate is that it reduces your income tax liability. Now, some mortgage credit certificate providers will allow you to take that tax liability reduction and annualize it to increase qualifying income again. So again, we're increasing purchasing power by increasing their qualifying income. Not every MCC provider does that, but some do. And some even will reissue that mortgage credit certificate through a refinance to the next mortgage they get through them. So those are great benefits. We love MCCs because of the lifetime value or the life of loan value that they provide, but also the fact that it's a tax credit, which is a big deal. I'll give you a quick example. Assume a $200,000 home. You buy it in January. You make a full year's worth of payments at 4% interest. You pay $8,000 that year. Let's say the mortgage credit certificate allows you to take 25% of that mortgage interest and claim it as a tax credit. Now, that percentage will vary. Some are 10%, 20%, 30%. Let's just say they'll let you take a quarter of your mortgage interest paid as a tax credit. That's $2,000. That is a $2,000 tax credit on your federal return. And the other $6,000 in interest that you paid, you still get to claim as an itemized mortgage interest deduction. So that's basically how an MCC works. Entire webinars are dedicated to breaking this down, but that should give you a glimpse into the value and the nature of a mortgage credit certificate. So we just covered a lot, especially about the three most common types of homebuyer programs, but we want to show you some unique nuances, scenarios, features, benefits that might help you recognize additional opportunities, might help put you in a position of being a value-added expert in a transaction, or might help you create a transaction where nobody else recognized the opportunity to do so. So targeted areas. Some programs, especially with state housing finance agencies, they may have unique benefits in targeted areas. Those areas are targeted because they are high foreclosure, increased blight, identified for reinvestment or additional investment. But part of this is live where you work. A lot of this is based on the idea of helping people live where they work. So helping core service providers, educators, first responders, and the like, help them live closer to where they work. In targeted areas, you will often see a waiver of any first-time homebuyer requirement if there was one. You will often see more down payment assistance dollars available through that same program in targeted areas than elsewhere. You will almost universally see higher income limits and higher purchase price limits within targeted areas. Now, to be clear, these targeted areas can vary, but we're talking about specific geographic areas. Sometimes that's a census tract or a series of them, or a zip code or a series of zip codes. It could be an entire city. It could be an entire county. It depends. But where there are targeted areas, it's important to know where they are and what the additional benefits or waivers are in that area. Now, another myth here that we can address is the idea that it's too expensive to buy a home in my market. Could be. Part of what these programs do in targeted areas is reduce the cost of purchase by increasing the benefits of the down payment assistance program. Now, targeted professions. We brought this up earlier. I'm going to dive in here and then we'll look at veterans. Educators, which doesn't just mean teachers. I'll come back to that. Law enforcement, which again doesn't just mean the patrol officer. Firefighters, healthcare workers, municipal employees. These are all categories of professions: educators, law enforcement, first responders, healthcare. Those are some of the most common professions for which in some markets we see unique programs or waivers for people in these professions, unique opportunities to inspire or compel home ownership for people employed in these professions. A common scenario would be something like a HERO program that offers assistance to people employed in these professions, maybe no first-time homebuyer requirement, flexibility on income and purchase price limits. The idea is help people in these core service providing professions achieve home ownership. Back to the idea of educator, for example. That's a broad category. We all think teacher, but some of those programs would define an educator as someone who works for the K through 12 public school system or an independent school district. That could be a librarian. It could be the school nurse. It could be any number of other people that aren't necessarily classroom teachers, but work in the education field. Same thing for law enforcement. Doesn't have to necessarily be a patrol officer in a car on the street. Could be people that work in the office, could be other staff that work for a law enforcement organization, sheriffs, corrections, and so forth. So When you are asking your clients what they do for a living, or loan officers, when you're pre-qualifying and you're asking them for pay stubs and W-2s and who they work for, think about what opportunities may be available in your area, in your market, for people in certain professions. Now, they would qualify for anything else, but their profession may qualify them for additional opportunities. Same thing for veterans. There are in some markets programs that are unique for veterans. A common benefit, not universal, but common, is that there's no first-time homebuyer requirement for a veteran, even if the general public may be subject to a first-time homebuyer requirement. Also, programs unique to veterans can often be combined with VA loans. Now, we often get the reaction that, oh, well, it's a VA loan, it's zero down, you don't need a down payment. Absolutely true. However, how cool would it be to give a veteran additional equity up front, or to help cover closing costs, like that scenario we talked about earlier, and make more competitive offers or bids on a property because they've got the help or the backing of a down payment assistance program? I'll give you an example of one that's available nationwide. The PenFed Foundation, which is the foundation arm of the Pentagon Federal Credit Union, they offer a program called the Dream Makers Grant. That is a 2-to-1 match as a grant of everything the veteran puts in, up to a $5,000 match that they can use for down payment and closing costs. It's allowed for active duty, veteran, reserve, and guard. And while you do have to be a first-time home buyer for that program, that is a grant. So if the veteran puts in $2,500, the Dream Makers program matches that 2-to-1. So that's another $5,000 as a grant. The veteran comes in with $7,500 to put toward down payment and or closing costs. They're in a better position. They can cover closing costs, maybe get a little equity, don't have to ask the seller to pay for closing costs, so they can make more competitive offers. So the benefits compound, right? But that's another scenario to consider. Are you in a market, a big military market? Are you working with a lot of veterans, loan officers? Are you using a lot of VA loans? This is a great way to add value and supplement cash to close for those veterans. Now, how do you access all this info? We just gave you a ton of stuff. We know we didn't make anybody an expert necessarily, but hopefully that makes you, or gives you some confidence and some excitement and some new perspective about DPAs that you can bring out to your marketing and your relationship building and your lead cultivation. So let's quickly show you some ways that you can access information about all of these programs to help you figure out what's available in your market and to bring these up in conversation. Anybody at any time can go to downpaymentresource.com and for free search for programs available in a particular city, at a particular address, within a county, in a certain neighborhood. And you can account for a lot of the eligibility criteria that we talked about today: household income, home ownership history, location, estimated purchase price. So anybody can go to downpaymentresource.com and do a search for programs. If you're in California, go to finddownpayment.car.org and you can search for programs anywhere in the state of California and even get additional information and detail about those programs and take that off to your clients and have a discussion about down payment opportunities. Now, if you are a member of one of these MLSs, I'm going to leave this on the screen for a moment, then we have partnered with your MLS. If you see them on the screen, they are a down payment resource partner. That means we have integrated down payment assistance program information into your listing system automatically, so that when you list a property without having to do anything, we will flag it as eligible for down payment assistance programs, if applicable, based on location and price. We will put a button, which I'll show you in a moment, on that listing that you can click to see which programs are available for that property at that location at that list price. And then take that out to your marketing, knowing that buyers interested in that property will be potentially eligible or will potentially have access to those down payment programs. The idea is to identify where these opportunities exist, recognize and define what those opportunities are in the form of specific programs, and help you raise awareness and take that information to your prospective buyers. Now, if you are a member of one of these MLSs, then look for this button on listings And that will tell you that based on the location and price of that property, there are some programs out there to help them. And specifically, which ones and their details. So look for that down payment button in your listing system on agent and on client reports, and then be ready for consumers to call you and say, hey, I saw that there's down payment help on that listing you sent me. Let's have a conversation. Additionally, if you are a member of one of those same MLSs, you also have Down Payment Connect for free. That is a lead generation marketing tool that allows you to give a consumer a DPA search experience on a page that is unique to you, that gives them a glimpse into how many programs might be out there for them, but requires that they reach out to you and contact you to dig in deeper, discuss next steps, and figure out what to do to take advantage of those programs. So this is a great conversation starter. We have an entire webinar dedicated to best practices with Down Payment Connect, marketing to first-time home buyers, getting creative on social media, websites, email, blogs, and so forth. If you are not a member of one of those MLSs that I had on the screen a moment ago, you can subscribe to a version of Down Payment Connect at downpaymentresource.com/DPC. Let me go back here. If you're a member of one of these MLSs, you already have Down Payment Connect. If you're not a member of one of these MLSs, or if you are a loan officer, you can subscribe to Down Payment Connect and do the same thing at downpaymentresource.com/DPC. That allows you to educate and engage new buyers, expand and enhance your marketing. Buyers get to complete a program search, so it's a fun way for them to engage in the homeownership process and incentivize them to continue to talk to you. It's a way for you to reach out to new markets and new audiences, enhance your digital marketing, and explore the details of the programs in your market. So we encourage you to use Down Payment Connect, whether you're a member of one of our partner MLSs, or if you still want to access that through a paid subscription, then it's a great tool. We've seen wild success from realtors and lenders all over the country, and we have entire webinars dedicated to showing you how that's done. Lastly, for those of you who just want a forum, if you want to listen in or participate and you want to engage in some dialogue or see what others are doing around the country with DPAs, with first-time home buyers, with their marketing, how realtors and loan officers are partnering and creating strategies for these buyers, then we encourage you to join our Down Payment Insiders group on Facebook. The URL is here. That is over 7,000 real estate agents and even some loan officers that are sharing success stories and challenges and marketing ideas, DPA program experiences and so forth. And they're just sharing ideas with each other all over the country so that they can learn from one another and implement best practices on their own. So I'll leave you with this. The renter mindset. What is the renter thinking today? They want to leverage low interest rates, which now are creeping up a little bit. They need help understanding the mortgage process. They will absolutely adopt our technology. They don't have a problem with that, but they don't know it. They have to overcome down payment misperceptions. The idea that they need 20% down, we have to combat that. We can't help the people that believe that until we convince them or educate them that no, 3% down, 3.5% down, 5% down, that's what you need. And by the way, there are down payment assistance programs out there to help you accrue that down payment. The reality for many of them is that they are leveraging credit to sustain their lifestyle, especially during and post-COVID. However, on the opposite end of the spectrum, many may have been saving money, working remotely, not taking vacations, things like that, cutting down costs. Some will be rebuilding employment history. We're going to have to deal with that, especially for you loan officers. We may see some scattered employment history, and we're going to have to help those buyers get qualified. There may be income instability as that becomes stable, or as we can help them stabilize income and income history. That's going to be something we'll see. We also know, and it's more and more apparent by the day and by the week, these buyers need help navigating a rapidly moving market with horrifically low inventory that moves at an enormous pace. They're going to need help. They're going to need help winning that bid. They're going to need help getting the contract, We need to be able to recognize the opportunity of a down payment assistance program and frame its value appropriately. With that, Mel, Fern, what's going on in chat and Q&A? And if anybody, we'll spend a few minutes on Q&A here, but we will be mindful of everyone's time. Maybe we'll spend a few extra minutes, but if you do have further questions later, you can reach out to us at info@downpaymentresource.com. So Mel, Fern, what's going on? Any trends we can address?
Yes, thank you, Sean. Lots of great questions today. There are a couple of questions related to mortgage credit certificates that I wanted to share with you. And there were a couple, I just wanted to group these together for you. So the first question here is there an income qualification for the MCC program?
Yes, across the board. But those incomes, again, are market adjusted and can be higher than we might appreciate. And there are sometimes targeted areas too.
Great, thank you. And the second question related to MCCs, this is another one from Thomas. The question is, can a VA mortgage be combined with an MCC?
Often, yes. And that's, again, back to offering value to our military servicemen and women. What a great way to position yourself as not only an expert, but somebody who just went above and beyond. Yes, there are plenty of scenarios where you can get a VA loan through the Housing Finance Agency and also access their MCC and take advantage of that tax credit opportunity as well.
Great, thank you, Sean. There's another question that came from Randall. And the question is, isn't the deferred DPA considered in the LTV and debt to income?
That depends on the duration of deferral. So I'm not sure if Fannie, Freddie, and HUD are all on the same page, but I think for conventional, if it's deferred for 5 years, you don't have to count the payment. If it's deferred less than 5 years, you do. I think that's accurate, but that might be different for HUD or VA. So that's sort of the answer. Is it depends on the period of deferral, the duration of deferral.
Great. And one more, Sean. This one comes up quite often, and it's related to people that do not have a Social Security number, but they may have a tax ID number. Are any of these programs available for them?
They may be. I'm not sure. So I know there's been a lot of discussion in the last couple of years about I-10, the eligibility of I-10 borrowers for DPA. That's something I think we might hear more about in the coming year. For now, it's probably not as common as it may be in the future, but I don't really have a better answer than that.
Great, thanks, Sean. I'm just looking through to see what other questions we have here.
Sean, I actually have a couple, some kind of themes that I saw while I was answering. We've had a great bunch today, and I don't know, Fern, if you already said this, I apologize. I was typing answers, but we will be sending out a copy of the recording. We had lots of people ask for that, so we'll definitely be sending that out to everyone in case you missed anything. But Sean, several people wanted to know how to find out about homebuyer education courses. I think some people may want to attend and then wanted to know where they could find these for their buyers.
So 2 points. One, great idea to attend. Go with your client. That's an awesome experience for your client. Take that message that you hear in that class and incorporate it into your marketing. To find out where to go, if you go to downpaymentresource.com and do a search, if you go to finddownpayment.car.org and you're in California and you do a search, if you're using Down Payment Connect and you get a lead, one of the things that we provide to you in the list of programs that you found is who are the participating lenders and who do you have to take a homebuyer education course, and if so, where? And so when you do a search in any of the ways we showed you to access this info, we show you who the homebuyer education providers are, or where the class is, or online registration.
Thanks, Sean. Another kind of theme that I saw, people asking how to find out about targeted areas. When you discuss targeted areas, a lot of people just kind of wanted some more information on that.
Yeah, so again, when you do a search in any of the ways we showed you to access this information, first of all, we will label any results based on the location where you searched as an additional option for targeted areas. So you'll see a different program entry for that. And in addition, we also provide you with not just participating lender and homebuyer education course info, but also links and contact information for the program provider and their resources. So that typically includes information about the benefits provided in a targeted area, if there are any for that program, as well as where those targeted areas are.
Thanks, Sean. I have a couple more. One that I answered quite often too was, does DPA slow down the process?
I would ask any loan officer that's listening in to throw in the chat, do you slow down transactions when you are originating DPA loans? And then I'll answer the question. Our answer is, we're building a webinar to combat that, among several other misperceptions, like the seller won't accept it. The loan officers that do the most DPA business, the loan officers that likely want most to partner with you and that know and respect and understand these programs, they also have relationships with the providers. They have a team of people that know what they're doing. They know how to get these loans through the pipeline. And I hear all the time on panels with loan officers and sales managers, in discussions with them, in presentations with them, we know what we're doing. We'll close in 30 days, just like it was a VA loan or a Fannie or a refi or whatever. So they don't have to. Now, there are a couple of exceptions. Some programs may have, certain components that require an extra 3 days, week, or whatever for the provider to do their work. That just has to be, that expectation has to be set up front. It's not the fault of the DPA that a transaction was delayed if everybody knows up front, this one takes 7 days longer. So part of this is setting expectations. I'll address that one more way. If you've got a client under contract, they've won an offer, and cash to close was not fully investigated, or they've been in the pipeline for a while and you got to update bank statements, and now there's a cash to close issue, and so now we're adding a DPA, that's not the fault of the DPA. That was just an issue that came up that has to be addressed, just as if it didn't appraise or an inspection failed. Same thing with the homebuyer education class. I mentioned earlier, take that class early. There's no reason for a buyer to wait till they have a contract on a home to take their homebuyer education class. In fact, I would say that's bad practice. Do it early, do it before you sign a contract. You're going to get a better prepared client. That buyer's going to be better prepared for the process, and they will have met one of the almost universally required, conditions unique to a DPA, because otherwise they may not have had to take that class, right? So anyway, that was several different answers, and curious to see if anybody chimed in on the chat about that. But a good loan officer who knows these programs is a great partner, because they will set expectations, and if they know what they're doing, they'll get it through the pipe in the same amount of time as any other loan.
Sean, we did actually have a couple of people chime in the chat saying that it didn't slow them down at all. So good news. I have one more that's kind of related, that we do get a lot, is where and how to find lenders that do down payment assistance.
So I've already answered that one way. Any search you do on any of the ways we showed you to access this data, whether it's from downpaymentresource.com, through the CAR tool if you're in California, if you get a lead from Down Payment Connect, all of those produce for you. The very first thing we show you when you click on the details of a program and the results of your search is a link to whatever the program provider publishes as their list of participating lenders. Most state housing finance agencies these days will also produce an additional list of their top producing companies or even individual loan officers. Those are the experts. Those are the ones that not only get it, but they do a ton of it. That's a great place to go for a partnership, but let's not overlook your own existing lender partners. Maybe the topic just hasn't come up. Talk to your lender partners that you have now, that you work with and trust now, and ask them which down payment programs they offer. If you're a real estate agent, ask your brokerage. Do they have any lenders in their network that they know work with DPA programs? Let's see. Well, I guess that gives you a couple of ways to look for top producers. But I would reach out to your network. I would check your state housing finance agency, would use our DPR tools, and find those loan officers that like and appreciate and understand and are good at DPAs. Maybe 2 or 3 more here. We want to be conscious of everybody's time, although it looks like we still have a huge crowd.
Yeah, Sean, I didn't, unless Fern does, I didn't really have necessarily any themes. If you want to just start going through the currently open, we still have several open questions if you just want to go through those.
Yeah, sure. Lots of them. Okay. So let's see. I'll tackle a couple of these, and then I'm going to leave our contact info on the screen here. So if we don't get to your question, we apologize. We had a huge audience today, and we've answered, it looks like, hundreds of questions already. Can you use down payment assistance programs with a jumbo mortgage? Anita, not typically. Max purchase price limits of the programs typically won't allow that. Although I will say, in a higher cost market, conventional loan limits, conforming loan limits are higher. So in that sense, sort of, but officially for a jumbo outside of conforming loan limits, typically not. Let's see. If you take the first time homebuyer class, do you have to take another class for a different type of down payment if you use another one? Sarah, that depends. You do want to take the homebuyer education class that is required for the DPA program you're going to use. Many DPA programs will use the same course or will accept anything from a HUD certified provider, but you are correct. There are some programs that require, program A may require this class, program B may require this other one. So it is important to make sure you take the right one that qualifies you for the DPA that you intend to use. Let's see. Jorge says, most of my loan officers said those helps are closed. I'm not sure what that meant, Jorge. I'm not sure if that was a question or a comment. Can you use these on new construction? What about trailer homes and manufactured? Carmen, new construction, yes, frequently. Not universally, but new construction is frequently allowed. Mobile homes, no. Manufactured homes or modular homes, often. There are many programs. In fact, I think more than a quarter of all DPAs allow for manufactured homes, and the trend is towards more of them. We've seen that over the last 2 years. More and more DPA providers are allowing manufactured home property types, but that's distinguished from mobile homes. So with manufactured, permanently affixed, built after 78, that kind of thing. Let's see. Monica, the great question. Why do some lenders not want to work with DPAs? Ask them, but some their companies don't participate, so they can't. Some of them have misperceptions about the difficulty. Some of them don't want to work with first-time homebuyers. I don't know. I can't speak for lenders that don't want to do it. I think increasingly we're going to see more and more lenders and loan officers pay more attention to these programs. And quite frankly, Monica, I assume you're a real estate agent. Pressure from real estate agents and pressure from homebuyers is going to drive that trend. And I think to some extent, more loan officers and more lenders are going to have to participate in down payment assistance programs because that's the way they're going to get purchase business and first-time homebuyer business. Let's see. I'll go for a couple more here since we've still got a big crowd. All right. So is it feasible to find a home with only $1,500 down? Okay. Actually, that's Michael. Let me read your whole question here. I have a buyer who only has $1,500 to put down. I've been looking at new construction where the builder picks up the closing costs. Okay. So yes, quite possibly. That's $1,500 your buyer has. The builder's paying the closing costs. And what about adding a down payment assistance program that can help? I don't know what the price of the home there is, but a down payment assistance program can help cover the rest of the down payment. So yeah, that's certainly possible. I mean, if you're talking about a $700,000 home in LA, then I don't know. But if you're talking about a $200,000 home, you're getting close. So yeah, talk to a loan officer. Maybe the builder works with loan officers that use DPA programs. And by the way, and Michael, this is sort of an additional part of an answer for you, but for anybody, new construction. So if you're working with builders as referral partners and you've built relationships with builders, they're typically building a neighborhood in a pretty narrow price band, right? most neighborhoods aren't going to be like 150 to 1.2 million. They're going to be 350 to 420 or something like that. If one home in that neighborhood qualifies for a set of down payment programs, all the homes in that neighborhood qualify for the same programs. So that's important to remember when you're out talking to builders. Sventek, if a buyer has plenty of cash, can they still use DPA programs? Sometimes. Now, plenty is broad, but a lot of these programs do have what's called an asset test. If you have more than, you know, 10, 20, $30,000 in liquid assets, then now that doesn't mean like 401k, right? But just sitting in savings, then they may ask you to use some of that money in order to use their program as well. Those requirements vary based on the program. Let's see. Oh, Michael, 270,000. Yeah, Michael, you're getting close there. What areas are we covering? It seems to be the entire US, so this is not just Georgia. Ebony, that's correct. These programs are everywhere. There are dozens and dozens of programs across Georgia and Metro Atlanta, but also Macon, Savannah, Columbus, Augusta, and so forth. And likewise in every other state. So no matter where you are, your state housing finance agency has programs. And then depending on where you are, there may be any number of additional city or county or nonprofit or other programs. Let's see, let me go back up to the top here. Virginia had asked earlier, how could it be a lower monthly payment if the loan is at 95% LTV? Why lower LTV when it is 95? Okay, so I think if I understand your question, Virginia, the idea is if you have 3.5% down and you're looking at an FHA loan, what if you used a down payment assistance program to get a little bit extra down payment help and get out of that FHA loan into a much better priced, lower MI cost conventional loan? That's the kind of thing that a down payment assistance program can help accomplish. Crystal had asked, would it be better for someone to qualify for the DPA first than the mortgage? Actually, you're kind of doing them both at the same time, and that's what should happen. You should go get pre-qualified for a mortgage through a loan officer, or you should send your client to do so. And while having that conversation, also bring up and discuss and investigate their cash to close position, as well as their eligibility for down payment assistance programs, and then figure out what's the best DPA for them. Go take that homebuyer ed course. While they go look for properties, now they've done their homebuyer ed course, they're pre-qualified, they're meeting underwriting conditions, and then just leave it at the property. If that's the best case scenario. Get everything else done up front, make sure cash to close is covered, make sure everyone's ducks are in a row with the DPA, and then have fun finding the property and prevent obstacles down the road. Let's see, people are staying. I'm going to keep going here for, well, we're way over here. All right, I'll do two more. And then info@downpaymentresource.com if we didn't get to yours. Let's see. Can these programs step up when there's a problem with the appraisal? That's a tough one, Randall. If there's a problem with the appraisal, you may not be able to get a mortgage for enough to cover. Well, let's see. Let me try to think about what you're thinking about here. Yeah, if the appraisal comes in low, if that's what you mean, then maybe you could use a down payment assistance program to cover the gap, but you're still going to have a first mortgage issue where they're not going to mortgage the property for more than it's worth. So I think there's a different underlying issue there. If someone has, so this is Richard, if someone has 30 to 40% DP, I presume that means down payment. Can you use this program? If you've got that much liquid money that you're putting toward a down payment, you may not even qualify. I mean, unless that were like an inheritance or a gift, that's kind of an outlier. It really depends on the details there. Why do DPA programs require such high credit scores, higher than many FHA requirements? That eliminates many good buyers. Sheila, agreed. There are some down payment programs that will go down to maybe 580 or so and be used with FHA. You're right. That does eliminate many good or otherwise eligible buyers. I can't really tell you why. I can tell you that's the nature of DPA programs. Is 620 is kind of the lowest FICO we see. There are some that go lower, to be fair, but I'm giving you kind of the most common scenario. As for the why, I guess to conform with conventional loan policies, and I don't know. You know what? I'll come up with a better answer for the why part. I hadn't thought about the why. Just track what it is, and that's what we do. But let's see. What if someone was on a forbearance on a home looking to sell then buy again? That's going to depend on timing, Sherry Lynn. When was that? Are they out of that now? How long has it been? And what first mortgage product are they anticipating using? So that's something the loan officer needs to take a good look at. Let's see. We're actually getting close to being done here. Susan asks, how about Arizona? Tons of programs, many dozens, and great ones. If you're in the Maricopa, Phoenix area, there's some great ones. The state offers some great programs. Pima, Tucson, all over the place. There's a Flagstaff program, just off the top of my head, all kinds of stuff in Arizona, Susan. If a lender doesn't offer a DPA program, can there be two separate loans, one for the DPA and one for the mortgage? Pam, not from two different lenders. So they're going to have to go to one lender to get their mortgage financing situated, including the DPA. If a lender doesn't offer down payment assistance, then the borrower, I mean, quite frankly, to be candid, the borrower was going to have to come up with a different down payment solution, or another lender is going to have to help out with different products, including down payment assistance. So just to be candid, to be frank, I'm not sure there's a different answer. Okay, guys, there are still some questions coming in, and we are way over. I want to be mindful of everybody's time here. I'm sorry if we didn't get to your questions. We've answered hundreds of them so far through chat and Q&A. If you have any additional questions after we get off here, then reach out to us at info@downpaymentresource.com. And again, we encourage you to try out Down Payment Connect either for free through your MLS if you are a member of one of our MLS partners, or check it out even to subscribe. It's very affordable, fixed price. You get some great marketing benefits. You get a unique tool that nobody else provides, and you can really enhance and expand your marketing. And I'll lastly put up our list of MLS partners. So with that, thank you all. Thank you for joining us. Thank you for sticking with us through all this Q&A. Have a wonderful day, and get out there and talk about DPAs. Thank you.